Are you paying too much for actively managed funds when an index fund might give you the same result for a fraction of the cost? You've probably heard that active management has the potential to outperform the market. But how often does that really happen? And is it worth the higher fees? Hi, I'm Keith Demetriades. Today we're discussing two investment strategies, index funds and actively managed funds. We'll talk about the pros and cons of each, when to use them, and how they might fit into your portfolio to create an effective strategy that avoids unnecessary fees. Let's start with index funds. They've exploded in popularity over the past few decades, and for good reason. Index funds are a type of mutual fund, or ETF, that tracks a specific market index, like the S&P 500. The goal here is simple, to match the index's performance, not beat it. So if the S&P 500 goes up 10%, your index fund will also increase by about 10%. But if the market drops by 10%, you're going down too. This passive strategy doesn't involve any buying or selling decisions by a fund manager. The fund just holds the same stocks as the index it tracks. And because there's no active management involved, the fees are lower. The low fees are really where index funds stand out. Why pay extra when you don't need to? For long-term investors, particularly those investing for retirement, the compounding effect of lower fees can be a game changer. Think of it this way. Every dollar you save in fees is a dollar that stays invested and keeps growing. Over 10, 20, or even 30 years, those small savings can add up to a significant amount of money. Index funds are especially effective in efficient markets, like large cap stocks or major indices like the S&P 500, where it's hard for even the most skilled fund manager to consistently beat the market. John Bogle, the father of index funds, he captured this idea when he said, "Don't look for the needle in the haystack, just buy the haystack." That's the beauty of index investing, broad exposure without the hassle. But let's dig into this a bit more. What exactly do I mean by efficient markets? In large cap stocks, there's so much publicly available information that it's difficult for a fund manager to have any type of edge. All the big players, think companies like Apple, Lockheed Martin, FedEx, are analyzed by thousands of analysts worldwide. This means that most of the available information is already priced into the stock, making it extremely hard for an active manager to find strong prospects the rest of the market hasn't noticed. Index funds also tend to shine when it comes to long-term horizons, like retirement savings. With lower fees, more of your money stays invested, and that compounding effect can add up over time. But before we get too comfortable with the idea that index funds are always the best option, let's look at the downsides. One of the biggest criticisms of index funds is that they lack flexibility. In other words, if the market is dropping, there's no one actively trying to protect your hard-earned money. You're riding the market down, no matter what. That's a big drawback in volatile markets or during downturns. In this scenario, active management can potentially be helpful by providing flexibility and protection. So let's talk about actively managed funds, where you have a professional manager or a team of managers deciding what to buy, hold, and sell. Their goal is to outperform the market, and that's the key difference. While index funds are designed to track the market, actively managed funds aim to beat it. The managers use research, forecasts, and their own judgment to pick investments that they believe will provide better returns than the broader market. While this can be true, it's not a given, and many investors make the mistake of assuming that paying for active management guarantees better returns. In reality, a very low percentage of active managers consistently pick winning investments. That said, active management can still offer value in the right conditions, which we'll explore next. We talked about efficient markets, so let's talk about inefficient markets, which is where active management tends to shine. Areas like small cap stocks or emerging markets often lack transparency, which means a skilled manager can find undervalued opportunities that a passive strategy like an index fund, they'd miss. For instance, small companies or companies in emerging economies, they don't have the same level of coverage or analysis as major corporations in developed markets. This allows active managers to use their research and their expertise to potentially uncover these hidden gems. Then there's sector rotation. In cyclical sectors like consumer goods or energy, active managers can shift their investments based on economic indicators and market trends. They may increase their exposure in sectors that they believe are about to take off, and decrease it when they predict a slowdown. This ability to adjust allocations on the fly can potentially lead to outperformance in certain market conditions. One of the key benefits of active management is its ability to navigate market volatility. Here's how that might look. Let's say the market has begun a significant drop. If you're invested in an index fund, you're stuck following the market down because you don't have anyone making decisions to protect your capital. But with an actively managed fund, a good manager can take steps to minimize your losses. They could theoretically sell off the risky assets and buy into safer ones, or even reposition your portfolio to take advantage of the downturn. This ability to maneuver is helpful in high volatility environments where flexibility is critical. You're paying them to make sure you're not going down with the ship. But what about niche investments? Specialized sectors like biotechnology, renewable energy, or technology. They require expertise that passive strategies might not be able to provide. A manager with deep knowledge and experience can make all the difference because they can make more informed decisions about which companies will likely succeed. An index fund simply doesn't offer this type of specialized expertise. And let's not forget about bond markets. They can be complex, and having a skilled manager who understands the ins and outs of these investments can add real value. Factors like credit risk, interest rate risk, geopolitical risk, and liquidity issues are crucial in corporate or municipal bonds. Active managers can analyze these elements and adjust the portfolio accordingly, potentially outperforming passive strategies in the fixed income space. But, and this is a big caveat, active management does come with higher fees. You're paying for that expertise, the research, the constant buying and selling of assets. Over time, these fees can erode your returns, especially if the active manager doesn't consistently outperform the market. This is why it's important to be selective about which actively managed funds you choose. Not all active managers are created equal. Some underperform their benchmarks after accounting for fees, which means you could end up paying more without getting the results you're hoping for. Since we've been talking about how to best manage our investments, let's also talk about the impact of emotions as they apply to decision making. This is where a lot of people get tripped up. When markets are turbulent, it's easy to panic and make irrational decisions, like selling everything when the market drops, only to miss out on the recovery. There's a concept known as the behavioral gap, which refers to the difference between the returns investors actually achieve and the returns they could achieve if they stayed invested through the market fluctuations. Often this gap is caused by emotional reactions, such as panic selling during a market drop or chasing trends during a market rally. Index funds can help investors avoid this trap because they encourage long-term thinking. You're not buying and selling frequently, so there's less temptation to tinker with those investments. On the flip side, actively managed funds can tempt investors to react emotionally to short-term market movements. So a skilled manager adds value by helping temper reactions to keep a portfolio on track. Whether you use an index, active, or a combination of both strategies, the key is for you to understand and be familiar with your investment strategy. This will boost your confidence, your sense of control, and trust in the process, and help prevent an emotional or an irrational decision. And lastly, let's address the cost of investing beyond fees. It's easy to get fixated on management fees, but there are other costs that investors should be aware of. Tax implications, for instance. Actively managed funds tend to have higher portfolio turnover, which means they buy and sell investments more frequently. Every time a gain is realized from selling an asset, investors may be subject to capital gains taxes. In a high turnover fund, this can mean more frequent taxable events, leading to a tax drag on returns. This is particularly important for investors in taxable accounts, as those capital gain taxes can take a chunk out of the profits you'd otherwise reinvest. By contrast, index funds usually hold the same investments for longer periods, generating fewer taxable events. Of course, there are tax-managed active funds designed to mitigate this impact. But for many investors, the natural tax efficiency of index funds is hard to beat. So how do you know when to use index funds and when to go with active management? Here's my take. It's not about picking one strategy over the other and sticking with it forever. It's in your best interest to understand when and where each strategy makes the most sense. In efficient markets like large cap stocks or the S&P 500, index funds are often the way to go. They provide low-cost exposure to a broad market without the need for active decision-making. But in inefficient markets like small cap stocks or niche sectors, actively managed funds can offer real value by finding opportunities and avoiding pitfalls that a passive strategy might miss. It's crucial to understand what you're invested in and why you're invested in it. Whether you're using index funds for broad market exposure or active management to navigate less efficient markets, knowing the role each plays in your portfolio is key to long-term success. This also goes to the idea of stewardship and using the right tools at the right time. Sometimes that means minimizing fees with index funds, and sometimes it means paying for the expertise of a skilled active manager. Ultimately, the goal is always to grow wealth efficiently while sticking with your values and your long-term goals. So to wrap up, index funds are great for long-term goals, efficient markets, and keeping costs low. They provide broad exposure to the market without the need for active management, making them an ideal choice for retirement accounts or markets where active management struggles to add value. Actively managed funds, on the other hand, shine in volatile markets, niche sectors, and inefficient markets, where opportunities are abundant but require a more skilled approach. I hope this discussion helps clarify how each of these strategies might fit into your portfolio, because being a savvy steward of your resources means making informed choices. I'm Keith Demetriades, and if you found this video helpful, be sure to like, subscribe, and share with others who might benefit from this information. And don't forget to hit that notification bell so you never miss out on future content. Thanks for watching. Make your life count.